The biggest ETFs offer the longest track records of great returns, the lowest expense ratios and fees, and offer broad diversification. We'll analyze the top 3 exchange-traded funds ranked in order of assets under management as of mid-2026. To help compare them, we'll look at all the essential information, including what they track, returns over the last 5 years, dividend yields, AUM, expense ratios, how to buy them, the main reasons investors choose each one, and who each one is best for. In the second part, we'll look at the main pros and cons of ETF investing and which funds are best. Before we start, please be aware that this is not financial advice, and the data is from BlackRock, Seeking Alpha, and Vanguard as of mid-2026. First on the list is Vanguard's VOO, which aims to track the S&P 500. It's so popular because you're buying into the largest publicly traded companies in the US, and each holding is weighted so that the larger stocks make up a higher percentage of the portfolio. It's currently the largest exchange-traded fund with over $920 billion in assets under management. According to Seeking Alpha, as of early 2026, its 5-year return is 78.9%, and its average annual return over the last 5 years is 15.7%. That return is higher than the average S&P 500 return since 1957 because it's calculated from the fund's 2010 inception. Meanwhile, the dividend was 1.05% last year, and the drawdown was 24.5%, slightly lower than the S&P 500's 25.3% over the previous 5 years. Its popularity stems from its very low expense ratio of 0.03%, which means investors pay only $3 per year for each $1,000 invested. Its price is $681 per share. However, you can purchase a fraction of it with the minimum investment of $1, as shown on Vanguard's website. You can easily purchase VOO through Vanguard or brokers like Trading 212, which offer 0 fees. VOO covers a wide range of sectors, with technology accounting for around a third of the total. It combines extremely low costs with precise tracking. Over long time horizons, minimizing fees is one of the most reliable ways to improve net returns. Even small cost differences compound meaningfully over decades. Despite aiming to track the S&P 500, it actually has 517 holdings. The biggest holdings are tech giants Nvidia, Apple, and Microsoft, which make up over 19% of the total holdings. Another major benefit is that it's so large. The liquidity is very high, which means it's easier to buy or sell during the day at a good price. And lastly, Vanguard was founded in 1975 by John Bogle, and VOO has been around since 2010, making it very trustworthy. The second largest ETF is the SPDR and P 500 ETF, ticker SPY. Just like VOO, it aims to track the S&P 500 index. Launched in 1993 by State Street Global Advisors, it was the first exchange-traded fund in the United States. To this day, it remains one of the largest and most actively traded ETFs in the world, with over $766 billion in assets under management. According to Seeking Alpha's website, its 5-year return is rounded to 78.6%, with an average annual return of 15.7% over the last 5 years. That's slightly higher than VOO, but the dividend yield is a tiny bit lower at 1% over the trailing 12 months. The expense ratio is 0.09%, which is more than triple that of VOO, meaning that for every $1,000 invested, you pay $9 per year. The price is $741, and you can buy fractional shares through many brokerage accounts. We can see from the sector breakdown image here that SPY sector holdings are very similar to VOO, with technology making up by far the largest part. Next, let's take a look at the holdings, which closely align with VOO, as the top 3 stocks make up over 19% of the total. So, why is it the second most popular ETF? Well, firstly, liquidity is unmatched, driven by its extremely high trading volume, which makes it attractive to active traders. While its expense ratio is slightly higher than competitors, the difference is minimal for shorter-term holders. Secondly, as it's the first exchange-traded fund listed in the US, State Street and SPY both have a significant reputation as being very trustworthy. Next up, we have the iShares Core S&P 500, which again tracks the S&P 500. By the way, this is the last ETF on this list that tracks the S&P 500. It launched in 2000 and is managed by BlackRock. Currently, it manages over $750 billion, making it the second largest on the list. The 5-year return is 78.6% as shown on the Seeking Alpha website, with an annualized return of 15.7% over the previous 5 years, which is again matching SPY. The dividend was 1.09% last year, around the same as the other two on this list. Also, it's worth being aware that the max drawdown over the last 5 years was 24.39%, which was almost exactly the same as the other two on the list. The expense ratio is 0.03%, which matches VOO and is far less than SPY. The price is $744, and like the others, you can buy fractional shares through many brokerage accounts. We won't go through the sectors and holdings as they are almost identical to the first two on this list, but you may be wondering why people pick IVV over the other two we looked at earlier. Well, firstly, it competes directly with VOO on fees and tracking precision. For buy and hold investors, it provides virtually the same exposure at one of the lowest costs available. Also, with it being around since 2000 and managing over $750 billion, is very trustworthy to most investors. It's also worth mentioning that BlackRock manages over $14 trillion and is currently the world's largest asset manager. If you're learning something new, please consider clicking the like button and subscribing so you don't miss out on more videos like this. Just be aware that you can purchase distributing or accumulating versions. Distributing means it pays out dividends to investors in cash, usually quarterly. While it's a distributing fund, most investors prefer to reinvest dividends manually or through a brokerage dividend reinvestment plan to achieve a compounding effect similar to an accumulating fund. Personally, I've always invested in an accumulating fund as it avoids the hassle of reinvesting dividends. The second major thing to be aware of is the stock exchange you're buying it from, as you'll want to buy the one in your account currency to avoid foreign exchange fees. With Trading 212, you can use the multi-currency account to avoid paying currency conversion fees. But be aware, you cannot hold foreign currency in some accounts, such as a UK stocks and shares ISA, due to HMRC regulations. Next, we'll look at the main pros and cons of ETFs by starting with the pros. They have grown dramatically in popularity for structural reasons tied to cost efficiency, diversification, and long-term evidence. Instead of attempting to identify the next winning stock, ETF investors participate in the collective growth of companies. For example, by investing in VOO, you can track the S&P 500, which has delivered around 10% annual returns, which is more than the average retail investor returns, according to an article by Forbes that references a study by Dalbar. The article claims that the average investor earned roughly 9.8% annually over the last 10 years, compared with around 13% for the S&P 500 index. A 3% difference may not sound like much, but when compounded over many years, it makes a huge difference. Funds like VTI or VOO provide exposure to more than 500 companies across industries such as technology, healthcare, consumer goods, financials, and more. If one company struggles, its impact on the total portfolio is low, which significantly reduces company-specific risk compared to owning individual stocks. Fees are one of the few variables investors can directly control. Paying 0.03% instead of 0.50% annually may not seem like much in 1 year, but over 20 or 30 years, the compounded difference adds up to a huge amount. The world's biggest ETFs are very clear and easy to understand, with no manager attempting to time markets. This reduces the risk of active management and poor decision-making. Now, we'll look at the main cons. Firstly, you must be aware that your ETF tracks a market cap weighted index, meaning larger companies have greater influence on performance. For example, VOO tracks the S&P 500, which is market cap weighted, and as a result, the top 10 holdings account for nearly 40% of the index. This concentration on mega-cap technology stocks can make many investors feel uncomfortable with that structure, leading them to consider equal-weight alternatives, particularly as many analysts are speculating on an AI bubble, and the top 10 stocks have relatively high price-to-earnings ratios compared to the rest of the index. A well-managed fund should closely mirror its benchmark. However, over very long periods there will be a tiny difference. The choice often comes down to preference rather than performance. Next, we have volatility, as ETFs may reduce company-specific risks, but they do not eliminate market risk. During bear markets, even a broad fund like VOO can decline 20 to 40% or more. Investors must be prepared psychologically and financially for volatility. So, which is best? Well, firstly, VOO or IVV are ideal low-cost core ETF holdings managed by the most reputable firms like Vanguard and BlackRock, and with the largest AUM. SPY is best for high liquidity and active trading. And lastly, VEA is great for international diversification and reduced exposure to technology, while still delivering a strong average return over the last 5 years of 7.8%. It has over 22% in financials and 18% in industrials, while having only around 11% in technology. Among the top funds here, I invest mostly in Vanguard's VOO because it's low cost, reputable, and its website is very user-friendly for researching. It's also the largest ETF in terms of assets under management, and Vanguard offers many other ETFs to help you build a well-balanced portfolio. However, you should do your own research and invest in the option that best aligns with your investment goals. For many investors, a low-cost, well-diversified ETF serves as the foundation of a disciplined wealth-building strategy. While it may not represent a complete portfolio on its own, it remains one of the most efficient and reliable tools available for long-term compounding. You must balance a stock-based ETF like one of the top 10 we went through earlier with an ETF that gives you diversification away from stocks. A great way to do that is with a gold ETF, as it helps lower portfolio volatility and gives great returns. So make sure you watch this video about the top 3 gold ETFs next so you can find out the best options. Also, please consider liking and subscribing, as it helps me make these videos for you. Thanks for watching, and see you in the next one.